Hello and welcome to another lowvarates.com tutorial. My name is James Shergill, Government Loan Specialist and Licensed VA Loan Officer. Today we're going to be talking about the VA Hybrid Arm and what it can do for you. Before we begin, I'd like to cover a couple of the common reactions most borrowers tend to have with the loan process. Confusion and anger, because it leaves them feeling unsure about the decision they've made. The intent of this video tutorial is to make sure that we boil this down into plain English and demystify the VA Hybrid Arm so people can see its true value. So let's begin. What is the VA Hybrid Arm? The VA Hybrid Arm combines the advantages of fixed-rate mortgages and adjustable-rate mortgages while limiting the disadvantages associated with each, which I'll cover here in just a moment. The rates are generally fixed for up to 5 years, and once the fixed rate period ends, the rates don't necessarily go up. They are capped so that they can only adjust one time per year and never by more than 1% regardless of where rates are at. It's likely they could only move 0.25% or 0.5%, just no more than 1% up or down. And it can never adjust 5% higher or lower than the rate that it started at. More importantly, though, what separates most ARMs is the financial index by which its rates are determined. And this particular product is tied to the 1-year CMT, which is one of the more stable indexes out there. Right here, you'll see a graph of the 1-year constant maturity treasury rate index. And as you'll see, it looks like a wave, which tends to reflect what's going on in the market. The rates do move in cycles, as does the economy. But what's interesting about the CMT and this particular graph is that you can actually trace what happened during these time periods, and it kind of makes a little bit of sense. So right here, between 2000 to the middle part of 2001, we had the end of the dot-com boom, one of the most explosive periods of growth in American history. Between 2001 and 2003, we had the downturn, which resulted from 9/11, certainly WorldCom and the Enron debacle. Rates were lower, and as things started to pick back up, we had the housing boom. And then over here at 2007, beginning of 2008, we had the banking crisis and aftermath. And as you'll see, 2010, the rates are really at an all-time low. Let's take a look now at a more numerical interpretation that you'll see in May of 2000. The highest the rate ever got on this particular index was 6.33%. The lowest it ever got is right around where the current rate is. It's at 0.35%. All signs point, bottom line, to this being a great time to refinance. And that ties in perfectly here to some of these frequently asked questions that I get about the hybrid arm. Let's go over them. What's the worst case scenario with the VA hybrid arm? The hybrid arm can be fixed for either 3 or 5 years. This particular example is fixed for 5 years. And what you'll notice is it's guaranteed fixed at 3.25%. And after that, if we're assuming a doomsday scenario, it could go up 1% a year for a maximum of 5 years. Now, it can go back down and go back up, but it can never be higher than 8.25%. So there's a 1% per year cap, 5% cap over the life of the loan. Next question. I've heard too many horror stories about adjustable rate loans. Why should I reconsider? Well, there's a number of reasons. Why banks will lend it to them is because if for some reason they default, the VA has pledged we will repay the lenders for a portion of that loss. Now, they're not going to sponsor or create a loan product that would make that likelihood a greater possibility. B, it's simply illogical to assume risk without details. The example that comes to mind is the Toyota recall that's happening right now. Let's say we heard on the radio that Toyota vans were all being recalled. Does that now mean that all vans should be recalled or that it's unsafe to drive vans, period? Well, of course not. And then there's making decisions based on worst case versus most likely. If I were to go outside today and get scared because I was afraid that an asteroid was going to come and hit me, well, that would be fairly silly because, that's a worst case scenario. It's not very likely, and for me to go hungry, it's kind of silly to do that. Now, it's most likely that I won't get hit by it, so that's what I'm going to operate by. There is a point where the worst case does factor into a possibility. I think we'll see, even in a worst case scenario, this tends to be better off for most people, especially those with debt. And lastly, most Americans already have an adjustable rate debt, even those who say they will never get into an adjustable rate loan, a mortgage anyways, and they're called credit cards. Let's look at some of the credit card statistics right now. So first of all, the average life of a mortgage, meaning the average life of a mortgage before it's either refinanced and paid off or before the home is sold, is 3 years, since 1999. But overall, since homeownership was really prolific post-1950, it's been 6.2 years. So what they're saying is the average American in 6.2 years will either refinance or sell and move from their home. Americans move an average of every 6.6 years. That data is as of the 2010 census. The average household credit card debt is $10,679. That's as of April 2009. And the average credit card rate is 16.7%. The average minimum monthly payment then, of course, would be $258.08 a month. So to break it all down, people are struggling. People have more debt than ever before. The housing market is very bleak, and the job market isn't much better. Let's take these statistics and put it into a real-world example, though.